You're listening to the Maple Tree Capital podcast, where we put retail first, institutions second. Please note that all opinions shared today are that only of Maple Tree Capital and no other party. Please do proper due diligence and seek proper financial counsel before making an investment decision. Nothing presented today is investment advice. You are listening to the Maple Tree Capital podcast. I'm your host, Henry Invests on X, founder of Maple Tree Capital. Welcome to In the Treehouse, where we talk about some of the moves that we've been making in our portfolios, Jonah Gold and Heartwood. We are nearing the end of July here. Almost the first month of Q3 is in the books, and really didn't make a lot of moves last week. The market remains pretty much near all-time highs, and valuations remain a little bit stretched across the board. Something that I've been noticing personally is really just that a lot of shitcos, if you will, or companies that are very speculative early in their business cycle, really don't have any financials to back up the innovation of their business. Those sort of companies are really running very, very hot. And I'm noticing that sentiment online on X and other retail platforms is also running pretty hot. And, you know, it feels like some stocks just go up 15 to 20% every day with no end in sight. Now, I'm not saying it's a bubble or anything like that, right? I'm just expressing caution based on the environment of the stock market that I'm currently seeing right now. So as to how that impacts the decision making I'm making over at Maple Tree Capital, you know, a little bit of caution, right? I think the most important thing to remember when we're going through a bull market like this is if you start to question your own strategy and say, well, you know, these stocks are up 30, 40, 50%, maybe I should be in those, then you're not really all that confident in your strategy anyway, right? Because if you think of it this way, whether you're a value investor or you're a growth investor, in order to reap the returns of that strategy thoroughly and completely, you have to invest the exact same way. You have to invest to your strategy throughout all sorts of different market cycles, because those strategies may underperform one year and outperform the next. If you start changing your strategy to really align with what the broader market is doing, then, you know, it's not really a strategy. You're just kind of chasing performance. So I think that's something that everybody should keep in mind right now. You know, I certainly shouldn't feel bad if you're watching a company that is maybe really speculative, starting to run, things of that nature. So just stay grounded in your approach. That's what I'm doing. And, you know, that leads to the portfolio moves this week, which are really nothing. No moves. Well, like I said, kind of just sitting, waiting, and watching. Have continued to trade covered calls on the Jonah Gold portfolio on Hims and Upstart. Would like to do Lemonade, but the book is just not as liquid there. And, you know, I think that is a strategy that gets more powerful the more shares and the more money that you have invested. I've watched it happen firsthand to me as I've progressed with my AUM growing. The next step to that is the ability to sell cash-secured puts. Now, this is just phenomenal. For those who don't know what that is, right? Say you have a company that you're really bullish on, and it's sort of trending down right now for whatever reason. Well, you can sell, say it's trading at $100 today. You could sell an $80 cash-secured put 3 weeks out for maybe like $2, right? So $200. And essentially what you're selling somebody the right to force you to buy that stock at $80 up until the expiration date. So if it goes below $80, you'll buy the shares at $80, and you'll keep your premium no matter what, even if it doesn't go to $80. So it's a very bullish way to sort of get exposure to names that you think maybe are oversold, and you'd really welcome purchasing the stock and holding it if that decline continues. So, you know, that is the next step up in the strategy that I'm running right now. It requires more capital because I'm not going to do it on margin. And right now, all the cash that I have is personally invested. So it's hard to sit on, you know, $6,000, $7,000 worth of cash just for where I am at my stage and how meaningful that can be at work versus just sitting in cash. But, you know, as I get more money to invest and things like that, that strategy becomes very, very powerful, and I think it may even prove to be a little bit more powerful than the covered call strategy that I'm running right now. And keep in mind, you know, this covered call strategy is occurring in a bull market, so sort of fighting an uphill battle in that regard. I think, you know, people always wonder, well, what am I going to do if the market trends down? I think being able to identify that trend, which is something that I've been studying a lot, reading one too many technical analysis books maybe. The one on my desk right now is Technical Analysis of Stock Trends That's sort of the Bible of technical analysis, if you will. But I think that strategy will be really powerful in downtrends, especially if we were to get another market like 2022 or 2023, where favorable growth companies are just not doing all that well. So that's a little bit about my thinking, what's going on, what's in the treehouse, I guess, this week. Not too much. I'm just kind of sitting on my hands. We got earnings season coming up. Upstart, Lemonade, Grindr, all of the big names are reporting along with the rest of the broad market in the next couple of weeks. So I anticipate that the In the Treehouse segment of this podcast will be a little bit more in-depth and thorough in the coming weeks. Right now, it's kind of just the calm before the storm. So yeah, excited to see what the market has over the next couple of weeks in store for us. But Netflix reported great earnings. Stock came down just a little bit. I think that's probably more of a valuation concern than it is, distrust in the business. So we'll have to see how the rest of the market does over the coming weeks. You're listening to the Maple Tree Capital podcast. It is time for the Macro Pulse, where we give you a complete overview of what's been going on and driving the markets from the macro perspective. So this week we got CPI, which came in a little bit hotter than expected, 0.3% month over month, 2.7% year over year, with core being 2.9% year over year, although core came in a little bit lower than expected. So really that's pushed a lot of the bigger banks to sort of, kind of seesaw between rate cut odds. It seems like there's still no definitive conclusion on where rates are going to go over the next two meetings, which would mean July and September. I think broadly speaking, most market participants expect that interest rates are going to come down by the end of the year. It's just a question of when and by how much. Sort of the $1 million question, right? But Goldman now says that a September 25 basis point cut is somewhere around 50% likely. So a coin toss that the Fed cuts in September. But really, I'm not entirely sure. Going back to that uncertainty, right? Well, we got another big piece of news this week. President Donald Trump has floated the idea with Republican lawmakers of firing Jerome Powell. Now, whether or not he can constitutionally do that, I think is another question. But it certainly seems like President Trump is going to maybe take action on that. And that's something that we've been talking about on the podcast for the past couple of weeks. Now, what I think happened is they floated the idea to test it against the markets last week. And, it didn't really go so well. So I believe it was Thursday that there was a headline that came out from one of the journalists, and it was like, okay, President Trump has shown a letter firing Jerome Powell to Republican lawmakers and has received broad support. That was the story that went out. And the market immediately started to sell down, especially a lot more of the high beta tech really got killed pretty quickly. So that was the market really not liking the news, right? Sort of showing the administration that was the news. And then all of a sudden, President Trump is in the Oval Office, I believe, doing a White House event with, I think, the Prince of Saudi Arabia or something like that. And essentially, he's live taking questions. And a reporter asks him about this. It says, hey, there's a story that you're going to fire Jerome Powell. Would you consider firing Powell? And basically, Trump says, I think Powell's doing a terrible job, calls him too late, but says, no, I wouldn't fire him. And the market started to rebound. So what I think happened, and this is a little bit of just my opinion, I think that the administration floated the idea of firing Powell to the markets to see how they would react, and the reaction was overwhelmingly negative. So then Trump sort of did his taco, Trump always chickens out, and sort of, walked back on that claim during the press conference, which kept the markets up. And so to me, even though the administration will say that they're not watching the market or anything like that, I think that was Bessent, the Treasury Secretary, telling Trump, well, hey, if we're going to try and maybe go down this uncharted path, we should test it with the markets to see how they would react, unlike what they did with tariffs. The markets didn't like it, so now the administration is more than likely not going to do it. And so, to me, it seems very clear that this administration, meaning the Trump administration, is very focused on keeping the markets up, keeping sentiment euphoric, because it's one of the only things that they have going for them into midterms. If you remember the Epstein feud that we talked about last week on the podcast, well, that has really only progressed with the Wall Street Journal publishing a story that President Donald Trump sent sort of a lewd birthday message to Jeffrey Epstein back in 2003. And so that caused Trump, or prompted him, to go on Truth Social and do another rant where he said he ordered Attorney General Pam Bondi to sort of release all of the files. Now, that has not happened yet. That was a couple of days ago, and he did say immediately. So once again, the wheels of the Epstein story just continue to turn. So we'll see what happens there. But I think this administration, this is heavily what I alluded to last week, is facing a lot of political pressure. Their policies, while maybe they're being efficient in the sense that they're cracking down on immigration and that they are running a deflationary government policy, at least that was the plan with Doge to cut spending. I think it's good in principle, the ideas that they've set forth, but the execution on those ideas, including tariffs, have been somewhat disastrous in my opinion. And so I think they know that. If they want to get anything done in sort of a MAGA movement, if you will, over the next couple of years, they're going to have to win the midterms because the margin in the House and the Senate is, quite frankly, just too small. And right now, I don't think the Republicans would win the midterms. So one of the biggest pieces that they have going for them into the midterms is the fact that the stock market is trading at all-time highs. So I expect them to be very, very cautious with that and really try and preserve a lot of those gains. That's why, although I'm seeing signs, and I touched on it in the first segment in the treehouse, although I'm seeing signs of some market froth in different pockets of the market, it's very hard for me to sit there and lean bearish just because I know what the administration's best interest is here, and that is to keep the market up, and that is to get interest rates down. So I think we could be entering a bull market that's maybe a little bit, well, definitely a lot hated, right? But maybe a little bit more resilient and long-lasting than people anticipate. So I think that's why for investors, it's very, very important to not try and fight the trend, to just sort of ride the waves of the market. And right now, the waves of the market are up. So that's a little bit about the macro. I mean, labor came in relatively good, right? June non-farm payrolls rose to 147,000. Roughly in line with the 12-month trend and signaling a cooling yet resilient labor market. And so, the markets themselves remain near all-time highs. Really not too much else going on. We've got big earnings next week. That includes Tesla, Google, Intel, Verizon, Coca-Cola, and many, many more. It'll be more of like a progression for the tech earnings other than Netflix, who reported on Thursday, and they always report first. So Netflix didn't say anything negative about consumer spending or the health of the consumer, but they're focused more on a subscription value proposition. So really the macro kind of just remains up in the air. Nobody really has a strong grasp on what is going to happen. I think there are a lot of strong opinions, but at the same time, to me, it feels like now a soft landing is more in the cards as the tariff impact is really not as pronounced as maybe the Fed and other market participants expected. And then also, in looking at an August 2nd tariff deadline now, the Trump administration has lowered the sort of broad-based tariff band, I believe from 20 to 25% down to like 15 to 20%, something like that. They have lowered the tariff rates. So I don't think we're going to go back to a spot like Liberation Day. Now, if you look at rate cut odds for July, there is only a 4.7% chance of a 25 basis point cut, with the market overwhelmingly expecting the Fed to hold interest rates steady. Now, if you go to September, though, there is a 58% chance that the Fed will lower interest rates by 25 basis points, a 2.7% chance that they will lower interest rates by 50 basis points, and a 39.3% chance that they will leave rates unchanged. So the market is expecting the Fed to start the cutting cycle in September. Now, let's say, okay, it's not going to happen in September. If you look at October, there is only a 20% chance, according to what the market is pricing in, that rates remain the same. So it does look like rates are going to be coming down into the end of the year. So that is sort of the recap of what's been going on in the market, and that marks the end of this week's Macro Pulse. This week's Stock of the Week is a social media platform that you may be familiar with. In actuality, you probably are very familiar with them. It's sort of the go-to spot anytime you have a very random question or you want to talk about something that's very niche and only has a small group of people following it. So with that, I think you can infer that today's Stock of the Week is Reddit, ticker RDDT. So Reddit is a social media platform, and I believe they have as many daily visitors as Netflix. Stock recently went public in the beginning of 2024, and really went euphoric since then, with the share price increasing from about $50 all the way up to over $200, so an increase of 350%. Since the all-time high in February, shares are down 34% and fell as low as $90 and sit at $148 today. So it's a very volatile stock. Trades at a price to earnings multiple of little under 30. So what really is the deal with Reddit? Now, full disclosure, I own this stock in the Heartwood portfolio for Mapletree Capital. It's a small position, but why do I own it? If you think about it, if you use Reddit, it's not very monetizable. It's a free platform. You go on there, you read information from people, you share your thoughts. You may see the occasional ad on your feed, but that's not really a durable business model for Reddit. It's just having ads pop up. So you'd think that they'd offer some sort of like Reddit subscription or things like that. Now that may be coming, but really what they do right now is they have awards. So if you really like a post, you can pay to promote it, or you can pay to give it an award. And so Reddit makes money there. But the big driver, and this is what I've been keeping behind the scenes so far in this pitch, of Reddit's value is the data that they have. So if you think about LLMs, meaning ChatGPT, Claude, Grok, right? They have to train on data, okay? So they pay for the data to train on. Otherwise, it would be stealing intellectual property or IP. And that's actually a big lawsuit going on right now for some of these smaller companies, right? They're having their data or their IP stolen by LLMs. Now, for Reddit, think about all of the data that they have. They have data about the most random questions and problems that people have had to solve for the past 15 or 20 years. They have data on all these very niche, small community groups or subreddits, as they're called, with different interests. And all of that information, if you could aggregate it with a search query, is very, very valuable. And so what Reddit has done, and I think it's the right move, is instead of trying to develop their own Ask Reddit chatbot or something like that, which I'm sure they could still do, but that's not the route that they've really chosen, they've decided to license their data to the OpenAIs, to the Groks, right, the XAIs, as a revenue stream, and to give them the data that they need to train their models. And the thing with Reddit, and this is why I think the stock is positioned for future success, is if AI continues to really become more and more powerful, well, then the underlying data that is training that AI should become more valuable. And so I think that Reddit's ability to be a price setter versus a price taker, with just the richness and the value of their data set, is huge. And so I think for that reason, the stock could be worth, multiples of what it's trading at today. It's currently a $27 billion company. Financials aside, if you're talking about a company that has the most valuable data for a lot of niche personal use cases, and they're licensing that, I mean, the potential seems enormous. If we look at some of the financials right now, over the last 12 months, they have revenue of about $1.4 billion. So that's not even anything to scoff at, really. $1.4 billion is up from 667 just in 2022. So you can see a lot of that data licensing is sort of coming into play. So it trades at a price to sales multiple of about 19. So relatively expensive, but they have enormous operating leverage in this business. So they were unprofitable in early 2024 and have sort of reworked themselves all the way back to profitability with a free cash flow margin of over 21%. And of that $1.45 billion in revenue over the past 12 months, $117 million has fallen straight to the bottom line. That is really, really impressive. That's a net margin of about 8%, and that should only improve as they scale and as their data becomes more valuable. So, not like I said, Reddit is not a name that I'm all in on. It's a very volatile, high-flying tech stock, and it'll go up and down in waves with market sentiment. But if you're talking about an AI play, I'm not even looking at Reddit's value as the social networking platform, which there's a lot of it there, right? But also, really, the data that they have and that they can license it out, I think will be super impactful. And it's something that I want to study a little bit more. It's why, for Mapletree Capital, I initiated us a small position, sort of just to kind of like keep tabs on it, right? Invest and then investigate is the saying on that. But most of my shares that I got were really, really cheap. So it's a little bit harder to look at it now. I have a position at $99 a share, so those are up 48%. But we'll continue to look at it. Really, the point of stock of the week is not to give you guys a very comprehensive stock pitch or anything like that. It's just to share ideas about names that are kind of compelling and make you think a little bit. So hopefully Reddit is one that makes you think. You're like, oh, I didn't think of it that way. That makes a lot more sense why maybe the market is a little bit more optimistic about it. And, you can go from there. So Reddit is this week's Stock of the Week. So normally I end these podcasts by answering the questions submitted by my listeners, but given that there are not too many listeners yet, sometimes there's not a question every week. So for now, what I'm going to do is just take a question from my girlfriend every week, who tends to, she knows investing, definitely doesn't spend as much time on it as me, but really sometimes points things out that, makes you think about it a little bit more and like, oh, I didn't think of it that way, or things like that. So she asks today, what has been the most pivotal moment in your investing journey? And surprisingly, and I think this may surprise maybe some long-term followers of mine who are reading this, it actually came probably 2 months ago. And it was when I read a book called Best Loser Wins by, I think it's Tom H. This book was transformational for me, or transformative. I mean, totally unbelievable. So essentially, the premise of the book is not to fight the direction the market is going. Now, that does not mean that you don't buy companies that are downtrending, right? That's not what it's saying. It's saying if you're trading, you have to understand the trend and you have to understand that premise of it when you're making a decision. So for instance, if I were buying a stock that I felt was undervalued, but was in a clear downtrend, even if it looked undervalued and I thought that the price of the stock was fair, it would be questionable maybe to go all in at that given point in time. Instead, what might be a better strategy would be to sell cash secured puts. What might be a better strategy would be to average in over time and sell calls as I go into the position. So really what it talks about is, yes, you can have a contrarian idea in fighting the market and the market trend. That can be right. But if you're able to trade with the market during that time, trade against where you think the stock is going long term, and you can just accumulate more of a position. You can make money on the way down, and then you feel a lot better about holding it. Basically, it's a lot of like hedge fund terminology, right? You have to hedge both ways, and I think the better that you get at it, or the more that you're looking at your positions, you're understanding the direction which the market is trading them. It doesn't mean you have to buy or sell the entire position or anything like that. That's not what it says. It just says that you can be selective in how you trade it, how you position size it, when you enter, when you add, when you trim, all these different things. And then the last core ingredient of it is really, now that you have this understanding of, okay, the market is in flows, right? It goes up and it goes down, and you want to ride the waves of it. Even if long term you think that a stock is going the other direction, you want to ride the waves, and you can make money while doing that to bolster your bet or add to your bet when the market turns. And it was so impactful because it told me, it's like, look, okay, and listeners, I think you guys will relate to this too, right? Like, we have money in our portfolio in long-term positions, right? We're not trading it every day. We're not buying and selling out of these positions. Now, the book is not saying, trade them every day, right? It's not the same. But what it is saying is that if you have $50 to $70 to $100,000 in a stock, and you're a very in tune, astute investor, and you're spending a lot of time looking at the market, and you understand general trends, well, then you can actually leverage that existing position, that existing long-term position that you have, and make some money trading it without really using additional capital. So that could be covered calls, right? That could be selling cash secured puts, although that would require extra capital, but really covered calls. And the other key point of that is, okay, so you sell covered calls, right? You're leveraging the money that you have. That doesn't mean if the trade moves against you that you have to just ride it out. If the trade moves against you, you can just close it out for a small loss. And if you really spend a lot of time looking at charts and going through it, I think this could be a better way to not day trade, but swing trade some of your positions and use those extra premiums and money that you've gained to roll it into more shares so that you can increase to another 100 level threshold. And then once you get there, you can sell another option. And so you can kind of see how this snowballs very quickly. So some of that is an extrapolation of the book. Really, the book's main core key principles are to not fight the trend of the market, to not think you're smarter than the market, at least in the short term, and to sort of just ride the ebbs and flows of the market and then use that to your advantage in your position sizing, your trims, your buys, and things like that. And I think it added a layer of thinking for me. My thinking on businesses has always been, if I think the intrinsic value of a security is higher than what it's trading at today, well, like Buffett and all the greats say, buy it immediately, right? Or if you have a strong opinion on it, right? And so I think that's the right way to do it. But, in today's market, where trends and technical analysis do hold some weight as to price action, you can see distribution and how people are trading the stock. I think if you can combine the two and just follow the flow of the market over time, you can use it to build up a bigger position in the underlying security that you think is undervalued. Now, the key part of that is if you sell a covered call or something like that and the trade moves against you, you don't want to get your shares called away if it's a very long-term position that you're really bullish on, right? So there's risk management, as there is with all of trading, having a stop loss and things like that. But over the past couple of weeks in a rising market, I've been able to accumulate a lot of premiums in some very high volatile names by selling at strike prices that I think are reasonable. And I never chase premiums, so I never chase a strike price just because I like the premium that it has. I trade key levels on charts that I think, pose good levels of resistance over whatever the time of the option is. And so I think it's just food for thought. It's been probably the most pivotal moment in my investing journey, certainly recently, of just thinking about a little bit deeper. I'm accumulating these positions. How can I leverage them? How can I use them a little bit more? And it's more important for those who want to be in active management, who maybe want to run a hedge fund like myself, versus those who are just passively investing, right? I wouldn't recommend it for that. But if you're a student of the markets, if you're like me and you're looking at the markets every single day, you know the general sentiment of the market. You know that the Fed has a meeting next week. You know that, okay, the Fed, if they don't raise rates or if they don't cut rates and then they say XYZ, that's bad for the market, right? If you have that information advantage in that you're spending a lot of time following the market, well, then you should use it, because I don't think every trader has the same information advantage. So I think what I'm trying to say is the book says, if you have a very strong understanding of a business and you have a very strong understanding of what's going on around in the world, and you can read charts really well, the power of those three, I think, is unparalleled, and it can give you some success in investing. So that's sort of the most pivotal moment in my investing journey, certainly recently. It's given me a little bit more drive, and it's really just, I think, evolved me one step higher in being an active manager and being an investor. So thank you for listening to this week's Maple Tree Capital podcast, and I hope everybody has a great rest of their weekend, although it is Sunday, and I hope to see you all next week.